Friday the 12th of July 2019. I'm Steve Towers. Welcome to ITB. Coming to you today from the Sydney Opera House. Let's get started. In France, the DST bill has been passed by the upper house of Parliament, the Senate. It has now been passed by both houses. The next step is for the bill to be signed into law by President Macron. He has 15 days to do so. However, this 15-day period can be frozen if the bill is referred to the Constitutional Council for review. If the bill does become law, a 3% DST will be imposed, effective from the 1st of January 2019, on turnover from online advertising, the sale of data for advertising purposes, and online marketplaces. It will apply to companies with group turnover from these digital activities of more than 750 million euros globally and more than 25 million euros in France. For a copy of the bill, please go to our website or app. In the UK, the government has released its DST bill. This will be a 2% tax, effective from the 1st of April 2020, on the revenue derived from the provision of a social media platform, a search engine, or an online marketplace to UK users. The tax will be applicable to companies with group revenue from these digital activities exceeding £500 million globally and exceeding £25 million from UK users. For a copy of the bill and related documents released by the government, please go to our website or app. As you would expect, the US has reacted negatively to these developments in France and the UK. In regard to France, the US Trade Representative has initiated an investigation under Section 301 of the Trade Act. This is the same procedure which was used to impose the increased tariffs on imports from China. For a copy of the announcement by the US Trade Representative, please go to our website or app. And in regard to the UK, senior members of Congress from both major parties said yesterday that the UK DST would reduce the prospects for a post-Brexit UK-US free trade agreement. The digital taxes proposed in Austria and the Czech Republic are progressing. In Austria, the bill for the 5% tax on digital advertising revenue is scheduled to be voted on by the lower house of Parliament on the 25th of September. And in the Czech Republic, the legislative process for the 7% DST commenced last week. Meanwhile, in regard to the Inclusive Frameworks Programme of Work, there have been two major public conferences in the last 2 weeks, in Munich and in Oxford. At both conferences, senior OECD and national officials spoke at length about the program and emphasised the need for a political consensus by the end of this year. But there were no major developments announced. You'll remember that India recently increased its customs duty rates on a range of imports from the US in retaliation for the US terminating India's status as a beneficiary developing country under the Generalized System of Preferences program. Well, the US has now responded by initiating a WTO dispute consultation process. For a copy of the US government statement, please go to our website or app. And the UN has released an updated version of its tax treaty negotiation manual. For a copy of the updated manual, please go to our website or app. In Australia, the tax authorities have released a consultation paper on the Reportable Tax Position (RTP) schedule. The paper considers a proposal to expand the RTP schedule to large private companies and corporate groups. For a copy of this paper, please go to our website or app. Also in Australia, the tax authorities have issued updated guidance on the effective life of depreciating assets, which determines the depreciation rate. The guidance is effective from the 1st of July. For a copy of this guidance, please go to our website or app. And finally, in Australia, commentators have pointed out that recent guidance issued by the tax authorities in regard to the interaction of the transfer pricing rules and the debt equity characterisation rules contains a technical error. You remember that I covered this guidance in last week's ITB. The technical error is that Example 2 states that Australian interest withholding tax would apply, whereas in fact it would not. Interestingly, the tax authorities have this week corrected a typo in the guidance, but have not yet mentioned this technical error. In India, the government has presented its 2019 budget. From the perspective of multinationals, here are the items that caught my eye. Firstly, there's no change in the corporate income tax rates, but there is a change in the ceiling for the existing lower corporate income tax rate of 25%. That ceiling will be increased from total turnover of 2.5 billion Indian rupees, which is about 35 million US dollars, to 4 billion rupees, which is about 60 million US dollars. When you factor in the surcharge and cess, this change would result in an effective tax rate of 29.12% for companies with a total turnover of less than 4 billion rupees and 26% for companies with total turnover of less than 10 million rupees. Secondly, the existing buyback tax, which is payable by a company on profits distributed to shareholders via a buyback of shares, will be extended to listed shares effective the 5th of July. Thirdly, if property situated in India is transferred by a resident to a non-resident for nil consideration or for consideration below market value, the non-resident will be deemed to derive Indian-sourced income, equal to the difference between the market value and the actual consideration paid. This change is effective the 5th of July. However, this domestic law change would be subject to any double tax treaty exemption. In regard to transfer pricing itself, a number of changes are proposed to the existing secondary adjustment rules. Under these existing rules, a primary TP adjustment will require an actual cash movement to India, failing which an ongoing secondary TP adjustment in the form of imputed interest can be made. The most significant proposed change to these rules is that the requirement to repatriate the cash to India and the ongoing imputed interest can both be avoided by the taxpayer exercising an option to pay a one-time tax at 18% plus surcharge on the cash which is not repatriated. And the final point I noted is that the government is proposing further incentives to promote international financial services centres in India. In Indonesia, the government has introduced a number of tax incentives to encourage R&D, job training, and investment in labour-intensive industries. For a copy of the government statement, please go to our website or app. In Malaysia, the tax authorities have released guidance in regard to the earnings stripping rules, which became effective on the 1st of July. For a copy of the guidance, please go to our website or app. In Singapore, the government has launched a public consultation in regard to proposed GST changes. The most significant of these changes is the proposal to exclude virtual currencies such as Bitcoin from GST. With effect from the 1st of January 2020, two related changes are proposed. Firstly, the use of digital payment tokens as payment for goods or services will not give rise to a supply of those tokens. And secondly, the exchange of digital payment tokens for fiat currency or other digital payment tokens will be exempt from GST. Public comments are requested by the 26th of July. For a copy of the consultation documents, please go to our website or app. I have three cases from the European Court of Justice, all in regard to VAT. The first case is called UniCredit, and it's on referral from Bulgaria. The case concerns Article 90 of the EU VAT Directive, which says this: 1. In the case of cancellation, refusal, or total or partial non-payment, or where the price is reduced after the supply takes place, the taxable amount shall be reduced accordingly under conditions which shall be determined by the member states. 2. In the case of total or partial non-payment, member states may derogate from paragraph 1. The key issue in the case concerns the interpretation of paragraph 2. Bulgaria had indeed derogated from paragraph 1 by not having any provision which allowed the taxable amount to be reduced in the event of non-payment. However, the court held that despite paragraph 2, the Bulgarian tax authorities must allow a reduction in the taxable amount if it is reasonably likely that the debt will not be paid. For a copy of this case, please go to our website or app. The second case is called Cursu, and it's on referral from Latvia. There are two key facts in this case. Firstly, the taxpayer acquired goods at the end of a chain of successive sale transactions between several persons. And secondly, the taxpayer took possession of the goods at the warehouse of a person forming part of the chain, but not the person which sold the goods to the taxpayer. In those circumstances, the Latvian tax authorities had denied an input tax credit to the taxpayer on the basis that those two facts showed that this was an abusive practice. However, the tax authorities did not identify any undue tax advantage which was obtained by the taxpayer or any other person in the chain. The court held that those two facts are insufficient to establish the existence of an abusive practice. Therefore, the Latvian tax authorities must allow the taxpayer an input tax credit in regard to its purchase of the goods. For a copy of this case, please go to our website or app. And the third case is called Federal Express, and it's on referral from Germany. This case concerns the VAT position of goods which were couriered by the taxpayer from outside the EU to consignees in Greece. The goods entered the EU by air, arriving at Frankfurt Airport in Germany, but were then transferred to another aircraft for delivery to Greece. The taxpayer infringed the German customs law, which caused it to have a customs debt in Germany. The issue in the case was whether, in these circumstances, import VAT was due in Germany or in Greece. The court held that the answer is Greece. For a copy of this case, please go to our website or app. Also, in regard to the European Court of Justice, Advocate General Julianne Cocotte has issued her opinion in the Tesco case, which concerns Hungary's now repealed turnover-based tax for retail undertakings. The opinion considers the EU freedom of establishment and state aid issues. You'll remember that she recently delivered an opinion on similar issues in regard to Hungary's turnover-based telecommunications tax. Both of these opinions have generated interest because they might also be relevant to other turnover-based taxes, such as the digital services taxes, which are being introduced in some EU member states. In fact, this most recent opinion in the Tesco case contains some references to the European Commission's DST and France's DST. For a copy of the Tesco opinion, please go to our website or app. This week's ECOFIN meeting struggled with the challenge of finding new sources of revenue for the EU budget to fill the hole which will occur if Brexit actually happens and to finance new initiatives. Although decisions have not been made, it looks like there is some degree of support for some green taxes, a tax on unrecycled plastics and a carbon border tax, which would impose a tax on goods imported from countries which don't adhere to the Paris Agreement on climate change. However, the plan for the Common Consolidated Corporate Tax Base, the CCCTB, was described by one participant as dead. And speaking of green taxes, France has announced the introduction of an aviation tax in 2020. The tax will apply only to flights which originate in France. The amount of the tax will range from 1.5 euros on economy class tickets on domestic and European trips to 18 euros on business class tickets for destinations outside Europe. In Greece, as I'm sure you know, there's been a change of government. The new Prime Minister has promised to reduce the corporate income tax rate from the current 28% to 20% in 2 years. Under the previous government, it was scheduled to progressively fall to 25% by 2022. However, whether Greece's creditors and the EU will allow the rate to fall to 20% remains to be seen. In Switzerland, Expert Swiss, an organisation of Swiss certified auditors, tax and fiduciary experts, has issued a paper on the accounting impact of the recently approved Swiss tax reform legislation, known as TRAF. For a copy of the paper, please go to our website or app. In the UK, the government has launched a public consultation in regard to a proposed amendment to the rules on hybrid capital instruments. The proposed amendment is to ensure that the new rules operate as intended for instruments whose terms include a takeover or change of control provision. The amendment allows tax deductions for interest paid on instruments of this type, so long as they meet other conditions in legislation. The consultation runs to the 9th of August. For a copy of the consultation documents, please go to our website or app. In Nigeria, the Tax Appeal Tribunal has decided a case in regard to the so-called excess dividends tax under Section 19 of the Companies Income Tax Act. The tribunal's decision is in line with earlier cases decided by the Federal High Court and the Court of Appeal. The case concerns a situation where a Nigerian company recorded no profits for 2014, but it paid a dividend in 2014 from its 2013 after-tax profits. The tribunal held that under Section 19, where a company pays a dividend in a particular year and the amount of the dividend exceeds its profits in that year, the amount of the excess shall be deemed to be the company's taxable profits in that year, regardless of the fact that the dividend was paid out of profits from an earlier year in which the company paid income tax. Accordingly, the company was subject to additional income tax on the whole amount of its dividend payment. In Brazil, the government has issued guidance on the application of the tax on financial operations to delayed remittances to Brazil of export revenue. The guidance aims to ease the complaints which have been made since the tax authorities started to enforce this application of the tax earlier this year. The guidance allows for a delayed remittance of 750 days for export revenue without the tax operating. However, the tax will be applied if the remittance is delayed beyond 750 days. Commentators have criticised this new guidance on a number of grounds, including the practical difficulty in proving the remittance delay period for specific amounts of export revenue. For a copy of this guidance, please go to our website or app. Also in Brazil, the tax authorities and the OECD have issued a joint statement at the conference held yesterday in Brasilia to present the outcomes of the project to align Brazil's transfer pricing rules with the OECD transfer pricing guidelines. In the statement, there's a reference to a gap analysis which identified 30 issues where Brazil's TP rules either diverge from the OECD standard or don't address the issue. However, the statement gives no further details of these 30 issues. For a copy of the joint statement, please go to our website or app. In Chile, the revised tax reform package will be debated in Congress this month. The package contains some major differences from the original version introduced into Congress in late August 2018. From an international perspective, the most significant change is the replacement of the 10% digital services tax with a 19% VAT on inbound digital services. Interestingly, to ensure compliance, the tax authorities will be able to require financial intermediaries, such as banks and credit card companies, to collect the tax. In Costa Rica, the government has issued for public comment draft rules in regard to APAs. For a copy of the draft rules, please go to our website or app. And in the US, the government has issued proposed regulations in regard to PFICs, specifically concerning the so-called PFIC insurance exception. For a copy of the proposed regs, please go to our website or app. And now for this week's treaty developments. We've had one treaty signed, one treaty entered into force, and one protocol signed. I have 2 articles for you this week. The first article is called Another Front in Trade Disputes, European Digital Services Taxes and WTO Commitments. It's written by Gary Sprague and it's published in Bloomberg BNA's Tax Management International Journal. In this article, the author considers whether the digital services taxes, which are proposed to be introduced in a number of EU member states, will likely breach the WTO's General Agreement on Trade in Services, GATS. His conclusion is, yes, they will. He writes this: based on the descriptions of the various national DSTs that have been circulated so far, it appears that all of them would violate the EU's and the member states' market access and national treatment commitments under GATS by providing less favourable treatment to services and service suppliers of other WTO members, notably the United States. Through scope limitations on covered services and revenue thresholds, the proposed DSTs would impose taxes on services provided substantially by non-EU suppliers, while not imposing taxes on like services provided by European suppliers. Moreover, even if one could identify a legitimate exception justification for the national DSTs, the design and structure of the measures indicate that the DSTs will be applied in a manner constituting arbitrary or unjustifiable discrimination, or a disguised restriction on trade in services, and will thus be inconsistent with GATS. The second article is called Brave New World: Automation, Unemployment and Robot Taxes. It's written by Mike Hammer and it's published as an IBFD white paper. In this paper, the author discusses the potential threat to jobs posed by increased automation and describes some recent or proposed responses, including robot taxes and universal basic income. In regard to robot taxes, he writes, commentators have advanced various solutions that could mitigate the impact of automation. Microsoft founder and philanthropist Bill Gates suggests that as AI and other technologies flourish, governments will need to use taxes as a countermeasure. Gates proposes 2 alternatives. 1, an outright robot tax, or 2, a tax on the profits associated with automation. Both options represent, in the words of tax law professor Stefano Dorigo, a form of government intervention aimed at slowing down the pace of worker displacement at the hands of technological modernisation. And in regard to universal basic income, the author writes, Tesla CEO Elon Musk and Facebook CEO Mark Zuckerberg look beyond taxes to address the impact of automation. Convinced that automation will lead to mass unemployment, Musk and Zuckerberg maintain that governments will need to establish a UBI, that is, a periodic cash payment unconditionally delivered on an individual basis without a work requirement, which could be funded by taxing corporations that reduce the use of human labour as a result of automation. Critics of UBI caution that it is an extremely expensive and scarcely tested concept that would shrink the labour force and divert assistance from the most needy. Moreover, they point to evidence that jobs are changing as opposed to disappearing, and suggest that the United States may even experience a labour shortage due to the significant number of workers approaching retirement age. Well, that's the way it is this Friday, the 12th of July, 2019. I'm Steve Towers in Sydney. Have a great weekend.